Welcome everyone to the Investing with Al YouTube channel. My name is Al and I love investing. Today I'm going to be talking about what stocks I'm currently buying with my monthly deposits on Trading212. I make my purchase through a feature in Trading212 called a pie. Now, what is a pie? It's a way of buying a group of stocks in one go, saving you the time and effort to purchase each stock individually. Pie is allocated through a weighting mechanism, which means you can choose how much of your deposit goes to each individual company as a percentage. I have 19 slices in my current pie, ranging from 3 to 8%. And today I'm going to be talking to you about the top 10 companies on that list. The first company on the list is Broadcom, a relative recent addition to the pie as I try to ride the current tech and AI company boom, which requires the use of semiconductors, of which Broadcom is one such company. And it has a 5% allocation in my pie. So what are some of the metrics I look for when choosing a company I want to invest in? Look, there are many factors and metrics which you can spend hours and hours researching. However, these are the main ones I look at if you gave me a 5-minute window to assess a company. Firstly, 12-month share price. How has the company share price performed in the last year? Now, past performance doesn't always dictate how a stock will continue to perform, but it's a decent indicator. As a general rule, dividend payers will see lower share price growth, but non-dividend payers should be growing at least 10%, and if not, have some good reasoning as to why not. Secondly, PE ratio. This stands for price to earning ratio. Essentially, it signifies how much it costs to purchase a dollar or pound of profit that company makes. Generally, the lower the number, the better, but it varies from industry to industry. For example, tech or fast-growing companies, the PE ratio is higher. And again, generally speaking, a PE ratio of 20 to 25 are seen as good for a company. But be wary of really low PE ratios, as although some companies are seen as quote unquote cheap, they might have underlying issues of concern. So for example, if you go to a supermarket and bought the cheapest product possible, it might not be the best quality or use lesser quality ingredients, etc. So in the company sense, that low PE ratio may not be sustainable in the long term. The next one is net income. So how much does a company make after all its expenses, taxes, and general outgoings? So in real life, the example would be how much money hits your bank account from your salary after tax, national insurance, pension contributions, etc. It shows the general profitability of a company, and obviously the higher the number, the better. The next one is net profit margin. This is the amount of profit a company makes when it sells its product or service. As a general rule of thumb, 10% is seen as a healthy margin for a company. Lastly, cash and short-term investments. So essentially how much cash a company has available to them. Having cash allows a company to do so many things to increase share price and returns to its shareholders. They can make acquisitions, they can pay dividends, they can do share buybacks, and they can invest in more growth. So having lots of cash is a good thing for a company. So let's look at some of Broadcom's metrics. So 12-month share price, really good, up 106%. P ratio 39.54, so slightly on the expensive side. Good net income. They make 14 billion profit. That was for last year. Net profit margin really high, 39%. So some of these semiconductors have got insane profit margins. So really good. So they got about just under 15 billion in cash available to them. So really good company overall. In at number 9 is Abbvie with a 5% weighting. I've been into this stock for a while and I'm up 14.7% so far. This one is a good dividend payer, coming in at just under 4%. So some of the growth metrics won't be as high as Broadcom, for example. P comes in a little bit higher, but not overly. A standard net profit margin and a 12.8 billion in cash available to them. For me, this is overall a quote unquote stable investment, which you need in a diversified portfolio. And it pays me around £35 a quarter in dividends. Next one is another one with a 5% allocation, which is Apple. Just recently lost its title as the world's biggest company to Microsoft with a slowdown in sales of its core product being the iPhone. And this reflects into a sluggish share price performance for last year, coming in at just 7.1%. P ratio of under 30 is really good for a company which made $97 billion profit last year. good profit margins, and 60 billion in cash available to it is really strong. In at number 7, and the 6% allocation, is NVIDIA, the current AI superstar. I'm up 23.39% on this one. Look at these numbers. 213% growth in share price in last year alone. Most likely not sustainable, and the P ratio is pretty high, but I'm okay with that. I'm okay with share price moving a little bit lower, but I just want to highlight the insane profit margin of this company. 48.85% is crazy. The next two I'm going to group together as they are very similar companies, and these are Mastercard and VISA, both with 6% allocations. Both have really high profit margins at 46% and 53% respectively, and Mastercard having 11.2 billion net income and Visa with 17.27 billion in net income. I'll show you that here. Massively profitable and two of the biggest leaders in the space. Really good companies. I couldn't choose between them, so I've bought both. Okay. In at number 4, Tesla. Down on this one, 15.84%. Now I feel every portfolio should have one or two risky stocks within it, and this one is mine. I think electric vehicles will be the standard for the car industry in the future, and Tesla is head and shoulders above the competition at the moment. It is close to solving self-driving already, which would be a monster achievement. If you have some time to look at any YouTube videos of Tesla self-driving features and people currently using it, I think it's really, really impressive. So let's look at the numbers. Yeah, low share price, but that happens when Elon tweets from time to time. But Tesla made a $15 billion profit last year and has 26 billion in cash available for growth strategies. So not too shabby at all. All right. Number 3, Amazon with a 7% weighting, and I'm up just under 5% on this stock. 71% share price growth, a little high PE ratio, but I guess sometimes you have to pay a premium for quality businesses. It made 30 billion profit last year and has 85 billion in cash reserve. That's bigger than some companies themselves. Really good numbers. And yeah, this one has an 7% weighting in my portfolio. Right. Number 2, Google. I love this company. Up almost 20% on this stock, and I have more of it in my investment account. In fact, quite a few of these companies I have in my investment account as well. So my positions are actually quite bigger on these. 43% share price growth, a P of under 30 for a company that made 73 billion in profit last year. That's crazy. It's got 108 billion in cash. It can do what it likes. Right. Finally, top spot in my current number 1 stock. And if I could only buy one stock, it would be this one, Microsoft. 8% allocation, 33% share price appreciation last year, net income of 72 billion, 36% profit margin, and 111 billion in cash available to it. 41 P ratio is a bit high, but look at these numbers. I mean, they're just extraordinary. This is such a good stock. All right, just a disclaimer, I'm not a financial advisor. This is just my journey. If it inspires you to buy, great. If not, that's fine, but do your own research first. Thank you very much for watching the video, and like, comment, and subscribe. It will really help out the channel and yeah, getting out to more people who might find this interesting. Thank you very much. Take care.